Good morning, everybody. We're going to give just a moment for our participants to join the call. All right, well, welcome to our quarterly economic and market update. It's a pleasure to have you with us. It is October 12th, 2022. We do these updates each quarter on what's happening in the markets, and we like to also each quarter have a review for our clients on various financial planning topics. This one is more geared toward what's happening in the markets and our outlook and how that's affecting our portfolio designs. I'm Chris Boyd of Asset Management Resources. Thanks for being here. Brian Regan is our firm's Chief Investment Officer, and he will be handling the bulk of our commentary today. There will be an opportunity for questions at the end. If you do have questions, please note there is a Q&A box that you can add your questions at any time during the content. More than likely, we'll try to deal with those mostly at the end. If you find there's something that's unclear and you'd like us to offer some clarification, don't hesitate to comment in the chat area, and we'll try to offer that clarification as we go. You know, it's been a challenging environment this year. There's no question about it. And we've tried to do what we can to structure our portfolios in a way that will provide you the best returns we're able to within the way we structure our designs. Our hope today is to give you a little bit of confidence about how accounts are being positioned and all that we are doing on our end. We do not do a style of investment that moves us all in or all out of the markets. We try to work within the risk parameters that clients have indicated are comfortable to them and within their financial planning needs. That being said, it's an unusual year where stocks and bonds are both having challenges, and that makes for some challenging returns. So we're going to talk a lot about what's driving these issues. And to get us started, Brian's going to give us a little bit of an overview of what we have in mind today.
Yeah, thanks, Chris. Hi, everybody. So yeah, we're going to talk about where we have been positioned for Q3, give everybody an idea of how we were actually positioned. And then, a common question that Kathy Ingersoll, our marketing director, has been asking me is, when will we bottom out? And, at first I said, this is a struggling question to ask. It looked like in June we bottomed out, and then we made new lows very recently. And I think ultimately this is going to drive an inflation conversation that's going to be the bulk of this presentation. And then, finally, the Federal Reserve is they're going to approach this in what we call two acts. About a year ago, we had Act 1 and Act 2. I think that's very much in play again now. They're going to be very aggressive, and then they're going to be less aggressive. And this isn't me saying that. That is what the Federal Reserve has told us. They know that their policy works in what they call long and variable lags. So there will be a change in policy at some point, probably somewhere between north of 4.5% and 5% Fed funds rate is what they've told us. Then we're going to address some common questions, and then go through takeaways at the end. But first, how have we been positioned in Q3 of 2022? Well, we've been very, very defensive, and we have been defensive for the bulk of the year and progressively more progressive throughout the year. And in Q4, we're actually going to get more defensive. So I don't want to bury the lead there. We have been defensive. It's paid off for us over the last 6 months, and we're going to continue to get even more defensive. Sometime in 2023, we think we're going to start unwinding that more defensive position to get more towards a stable position. So what do I mean by that? Well, we've been very heavy in cash-like instruments. On the left-hand side, you see the 30-70 position. On the right-hand side, you see the 50-50 position. And these have already been rebalanced for the fourth quarter, and they're actually more defensive than this going into today than they were, a week ago. But this is how they were throughout the third quarter. 30-70 had about 25% stock, so more than 10% underweight. The 50-50 had about 43-44% stock, again, more than 10% underweight. Heavy cash-like instruments, those numbers, 13%, 11.5%. They're not cash. They're oftentimes short-term bonds or collateral. We typically hold a 3% cash position, but we have such defensive short-term bond instruments that sometimes they show up as cash. At the same time, we're filling in our stock positioning with credit positions where we think there's an opportunity. We'll get more into that later. But finally, I want to emphasize that we are very much involved in the developed market economies and specifically North America, with almost 90% in North America. It's the same story for the 65-35 and the 85-15 as we move up this risk scale. And the same story for the 60-40, 60% stock. Right now it's at 53% stock. So we're underweight stock, we're overweight cash-like instruments. We're heavily tilted towards developed markets with an emphasis on North America. And this has done, relatively well for us. Again, negative returns for the quarter, not what we'd like to see, but significantly better than, the benchmarks that we measure ourselves against. What is a major portfolio change that we made in Q3? Well, we sold our mortgage position. The ticker was DLTNX in your portfolios. And we bought more high yield and we bought more short-term bonds. So this chart here is through October 4th when I pulled it. So it's a little aged, but you can see that we had a negative return of more than 4% from the mortgages and positive returns through this date from the reinvestments that we made. So that was overall a good change, at least for the quarter. I talked about how we emphasize North America and developed markets in quality, but even within North America in quality, I think we have the best of the quality in stocks. So this is an example of the top 10 stocks that are in a 50-50 allocation, and it's going to be similar through each scale on the risk spectrum, whether it's 30-70, 65-35, or 85-15. These are likely going to be your top 10 stocks. So you can see that we're emphasizing Apple, Amazon, Alphabet, Pepsi, Johnson & Johnson, Canadian Natural Resources, which has been a very good performing energy type position. So we're not taking outlandish bets. We want to be in the types of stocks that are going to hold up throughout a recessionary environment or a poor sales environment and come out the other side and do very well for us.
Brian, before you change that slide, it might be worth just conveying how's that differ from, say, the index as a comparison.
Sure. So I'll just take the S&P 500 as an example. This is it shows an Apple weight of almost 2.4%. We'll double this because it's a 50-50. So let's say that in the ballpark of 4.8% for an Apple position, the S&P 500 has 7% in Apple. So what does that mean? Well, we're underweight Apple, true, but we are just more diversified than the overall index. We've talked a lot about how the S&P 500 is very top heavy, and it will go how some of the biggest stocks go a lot of the times, and we like to diversify out from there.
And even more so for like the Nasdaq 100, the QQQ. The point being, to your point, we're better diversified, more broadly diversified in many respects, less top heavy with some of these places where there's some challenges right now as well.
Right. So this is Kathy's biggest question, and I thought it was a great way to start this out. I'm sure it's on all of our minds. When will we bottom out? So the easy answer is it's hard to know for sure, right? I don't think anybody really does, but the bears will say that the market is down solely because of interest rates, and when earnings start to fall, the market will get worse. But the reality is, I think interest rates drive performance more than earnings. I don't really think that. It's mathematically true. And we've seen an exaggerated relationship between the performance of interest rates in the last 3 months. Now, it's been really, really difficult to determine where fair value is because we've seen volatility in the 10-year interest rate, unlike, multiple standard deviations away from what is normal. But the reality is when interest rates have risen, stocks have fallen. And when interest rates were falling, stocks rose. So we could see here over the last 3 months that when interest rates were low and plateauing, the stock market started to recover from that June bottom. And then when the Federal Reserve came out and gave us that ugly conference, the interest rates started to jump again. and the stocks started to sell off again. So there's a strong relationship here. So you got to ask yourself a question: what drives yield? What drives treasury yields? And inflation drives treasury yields, and the yield drives the stock. So I think we will bottom when we start to see some progress, some more significant progress in inflation. And that's really what the next bunch of slides is about: is when will we start to see significant progress in the inflation outlook. So right now, the Federal Reserve is slamming on the brakes. Last quarter, I talked about how, they could have a more cautious approach, they could slam on the brakes, or they could have a light touch. I think they've made it very clear to us that they're going to slam on the brakes and then move to a light touch kind of approach rather than have that cautious approach. That's important for our asset allocation. And that's really informing why we've decided to have even more defensive approach than we've had in the third quarter here in the fourth quarter. Inflation is high, and the Federal Reserve is the first to point that out. But it is falling as well, which I think is also important. And the rate at which it falls has become a new variable that we need to concentrate on. So here's inflation. This is core PCE. Well, the orange line is PCE, the purple line is core PCE, and the blue line is PCE month over month. Now, we can see that it topped out in June, and that's why we had that bit of a rally. But we can also see that it's plateaued, that the degree of which it's falling is plateaued. And we want to see that number fall where that red arrow is. We want to fall pretty dramatically from 4.91 down to 2%. And that's what the Federal Reserve is trying to do. So I'm going to talk a little bit about how the CPI is measured. And I think this all correlates with PCE. So sometimes I'm going to mix and match CPI and PCE. How it's measured, how that's going to influence what's going to happen in the CPI in 2023, what the Federal Reserve is doing today, how consumers' pocketbooks look. And we're going to come to a conclusion that it seems like inflation is going to stay elevated, maybe falling slightly, but not as much as we expected, similar to what we saw from the PPI this morning. Actually, it fell, but not as much as expected for the next 3 to 6 months. And then the market is determining that we're going to start to see some more rapid declines after that. And when we go through the data and the measurement specifics, I think you might agree. So here's a really interesting inflation chart to me. We've seen a dramatic services pop, and that's the red line. I want to concentrate on the red line for a second because that's 70% of CPI. So services are mostly made up of rent, but also medical care is a big portion of services. Now, medical care is a really interesting measurement issue because we actually measure it 12 months in arrears, or really 10 months in arrears, 10 to 12 months in arrears, depending on how you measure it. So it's been positive 28% over the last 12 months. And over the next 12 months, it's actually going to be negative 4%, at least that's the expected. So that's a dramatic change, and that should drag core inflation down. We'll talk more about rent, but rent comes in a 6 to 12 month lag, and we'll see that we're actually seeing market rents fall, but the CPI continue to rise because the CPI measures what's actually paid in rent, and market rents determine if you were going to rent something today, what would you pay for it. Now, finally, on durable goods, goods are about 30% of the inflation measurement. We can see that it's falling like a stone. I think some good rules of thumb just to try to gauge on where this is going is to think used cars and new cars. This is falling dramatically, but it's typically historically negative. So still positive, which isn't great, but we'll show some data on new and used cars, and it will show that there's some reason to be optimistic. So here's the rent situation that I was talking about before. You can see that the apartment list and Zillow listings are showing big slowdowns in the increases in rent that are being listed. And the orange line is CPI. So CPI is continuing to rise, and I expect that it will continue to rise as those, at the same time, those market rents will come down, and that CPI will come on a pretty significant lag. So if those numbers fall down to 5%, 0%, that CPI will still continue to rise for another 6 to 12 months, which is reason to believe that this core inflation, although falling, could continue to not fall at the pace that we'd like to see for another 6 to 12 months. Now, when we talk about rent, rent will be driven higher if wages are high and if people have the money to afford it. So what we're seeing here is that people have the money to afford it, at least on a historical basis. You can see that the percent change in bank accounts is still well above the pre-pandemic levels, and it was dramatically helped by the CARES Act, the December 2021 stimulus, and the American Rescue Plan. So, we talked about this in the prior quarter. We had some different charts showing that these drove inflation. And part of the reason in 2021 that we were in consumer discretionary names is because we knew consumers had a lot of money to spend. They've spent down some of it, but not all of it. And that could be a continued forward driver on something like rent, which is, again, one of the reasons why we're going to continue to be more defensive for the time being. Wage growth, it looks like there's a little bit of a plateau there, but we've had 2 head fakes in the wage growth, if you look carefully there. So I don't want to rely too much on that bit of a plateau that we've seen at the end. The reality is that wages are growing very fast, and this is going to filter into rent because people are going to have more money to pay more rent, and that could continue to drive that core rent PCE number further into the future. Now, all this is to say that the Federal Reserve has absolutely been slamming on the brakes. We've seen this dramatic change in the 2-year from, a year ago, well under 1, 25 basis points, to now we're almost 4.25. What does that do? Well, it makes things like used and new cars more expensive to buy. If it's your financing costs have gone up, 4-fold, 4 or 5-fold, it's going to be harder to buy a new car. And this is all in a balancing act between all that excessive checking account balances that we saw, coupled with the wage growth against the increased interest rate costs. And there's a tug of war going on between all those things in consumers' life. But what we are seeing is we're seeing a leveling off, especially in used cars. It looks like it plateaued and actually started going in the other direction a little bit. These are sales, not prices. And new cars plateauing, still high. It looks like it's in the process of doing the same thing that used cars are doing. And I anecdotally, I am noticing a lot more inventory in the lots as I do my channel checks. So this is, more blatantly showing what we talked about on the previous slide. I've showed this in Q3. I believe I might have showed it in Q2 as well. This is the Manheim Index. We saw this giant jump in January. I believe it was almost 45%. And then last quarter, it was down to 11%. And now it's a flat year-over-year increase. This is similar to, the same story that we were seeing on the previous slide, where used cars are reacting rather quickly and starting to reverse course on their prices, which is good news for that durable portion of the inflation index that we saw on the first slide that set all this up. Now, government spending drove a lot of the inflation. It drove a lot of the excess savings that we had, as we saw the CARES Act, the December 2020 Act, and the American Rescue Plan all led to those increased checking accounts. Well, we're not expecting to see that as dramatically going forward. 2022 government deficit is going to be 4.2% versus 12.4% and 15% in 2020 and 2021 respectively. And it's honestly likely going to be lower than 6% for the next 3-4 years, which is in better shape than most of what we saw in the previous decade. So although the headlines say that there's a lot of government spending, and there's also a bigger tax base, and that can help address some of these things, take out some of the excess liquidity. Now, how are we getting more defensive is ultimately the question. And one of the ways that we're getting more defensive is taking advantage of an opportunity that we're seeing in high yield. As these lines go higher, high yield essentially becomes less expensive. The price comes down. And we started some last quarter, but we're getting even more aggressive in the high yield market this quarter. And you say, well, this is high yield, this is risky, Brian. How is this less risk than what we're doing? Well, we're funding it mostly from our equity portfolio. And our equity portfolios ultimately, historically, at least speaking, more risky than high yield bonds. So this all boils down to two distinct periods that we expect to see. we expect to see an Act 1 where the Federal Reserve continues to be aggressive as inflation data, mostly driven by, I believe, rent, medical care, and used and new cars, starts to adjust to the new environment that we're seeing. Eventually, that's going to adjust. So if you listen to a financial commentary, a lot of people believe that the Federal Reserve is going far too aggressively, which is why that we're seeing some extreme volatility in the bond market, and that they're going to cause a recession that likely isn't, maybe a deeper recession that we need, that we don't, that isn't necessary. But the flip side of that is the Federal Reserve often says that they understand that this comes with long lags. And they know that once they get to a restrictive policy that they're going to have to pause. So they're telling us this. And so I'm calling this the light touch. And when they go to the light touch, we ultimately will see some changes in the bond market, which could spur that bottom that Kathy Ingersoll is looking for. When are we bottoming out? So this is the expected path of the Fed funds. So this is expected, what the market expects the Federal Reserve to do through 2025. And the interesting thing here is this starts to roll over at the end of the first quarter in 2023. So the expectation is that the Federal Reserve will not only have to pause in the first quarter of 2023, but it will even have to reverse course starting in the second quarter of 2023. So this isn't necessarily my opinion. This is what's baked into the market. And there's the light blue shows a wide range of volatile expectations the further you go out, which makes a whole lot of sense. There's less confidence in what's going to happen 2 years from now than there is 6 months from now. But ultimately, the market thinks that the Federal Reserve is going to push it a little bit too far, going to have to take their foot off the brake, and interest rates and yields are going to get a little bit of relief. Now, this is mostly going to be driven by the job market. If we showed that wages were very high at 7% growth. Well, part of that is because unemployment is too low. The employment picture is too good. It's too easy to get a job. We saw the job openings number, which is what this chart is showing, north of 11 million. Until very recently, there was a dramatic drop in it, and it fell to 10 million. Now, 10 million is still a lot of open jobs. So the job market, what the Federal Reserve would tell you, is still far too strong. But at least what we're seeing is this is a trend toward a weakening job market. We saw an unemployment number where the actual new jobs created was only in the 200,000s, which was down fairly significantly, still higher than what we hoped. In the labor market, the labor participation rate didn't go up, which was all concerning, and the stock market reacted to that. But the trend was still that the unemployment picture is getting worse. Again, inflation is too high, but it is falling, just not at the rate that we want. And it seems like with the extreme tightening that the Federal Reserve has done in 2022, with the lag, we will see those effects likely in 2023. And with the measurement of rent and medical care changing in 2023, I think at some point, I agree with the market expectations that inflation will start to roll over at a more aggressive rate in 2023 than it has so far in 2022. So what happens when that happens? Well, there's an extreme inverse relationship between the 10-year yield and the Nasdaq 100. It looks like I could have made this chart up, right? I'm just having the gold lines and the purple lines going opposite directions, but this is the reality of what's happened over the last 6 months here. As Treasury yields have gone up, the Nasdaq's gone down, and if Treasury yields went down, the Nasdaq went up. So if there's a heavy correlation between the 10-year and inflation starts to roll over significantly, well, then we want to be more heavily into those stocks like the Nasdaq 100. Now, right now, we're very, very defensive. We plan on being defensive for a little bit. I want to emphasize that. But part of the reason why you have Nasdaq-like names in your portfolio is because we want to be in a position to take advantage of this when it does roll over. Again, the market's expecting this to happen sometime in the second quarter of 2023. The market has been wrong. It could be wrong. It's something we're monitoring. But this is all to say that, when Act 2 comes, we're going to want to get in a position we're going to want to get more aggressive at some point. And, that could be difficult to wrap our minds around because things have been so negative for the last 10 months. So some more common questions. What are the average losses investors are experiencing nationally? So we got this one in yesterday. It's tough to answer this question with any degree of certainty because I don't know how people are trading. I don't really know people's allocations. But what I can show you is the indexes, and hopefully you can compare your portfolio to these indexes. And I know for a fact that our strategies are doing significantly better, although negative. I mean, this has been a tough time. But starting with the pink line there, the aggregate bond index is down 16%. The total stock market, whether you're looking at the S&P 500 or the all country world index, is down between 25 and 27%. The Nasdaq's down almost 34%. And if you're into cryptocurrencies, the Bitcoin futures ETF is down almost 60%. So there's a lot of red across the board, not a lot of places to hide. This is why we've been defensive. This is why we're going to continue to be defensive. But the reality is, at some point, this is going to reverse course. And we need to make sure we're in a position to do that as well.
Brian, one thing that's worth talking about as it relates to this for our clientele who are participating in our discretionary portfolio management services, when it comes to these lines, I mean, it's unusual that bonds are moving in such a correlated way with stocks where everything's going down simultaneously. But one of the things that we've been benefited from was our decision to be much shorter in duration, which is to say interest rate risk. And the degree to which we've had the negativity that the bonds reflected in the aggregate bond index here has been much less so, or at least notably less so. So that's been a help. And of course, some of these decisions you're talking about with where we position the portfolio on the equities, and now the decision to enhance our high yield exposure, because that's likely to benefit from some of these the circumstances we're in. These are things that can help people get some perspective. You started off talking about how we're positioned in the portfolio, but I just wanted to add a little bit of commentary there that when it comes to some of these individual choices, the things you talked about right at the beginning, shorter term bond exposure, an underweight in equities, an underweight in international exposure, the addition of high yield bonds, all are incremental things that should help our clients have performance that would be benefited relative to a proportionate index of these kinds of investments they might otherwise be looking at.
Yeah, they've certainly helped. I think what I'm most concerned about, and what I think this presentation is really about, is how are these lines going to look like 3, 6, 9 months down the road? There's no guarantee that the trajectory is going to keep going lower.
Right.
And that's about what portfolio positioning is all about, right? So, yeah, to your point, that our bonds have outperformed that 16.37, every single fund that we own, and the ones that we emphasize have outperformed it by a dramatic amount. It's not to say it's not negative, but it's significantly better. And another thing that I think is interesting to point out, the pink line is down. That's the bonds, right? It's down less than the stocks, sure. But more importantly, the line is a lot straighter than those other lines.
Yeah.
And that's one of the reasons why we like to emphasize that most people should have bonds in their portfolio, because it can be very difficult to ride those, more severe downtrends that were happening. And it can feel more euphoric, of course, when the that Nasdaq line eventually comes back, for example, and it will come back at some point, and that blue line will surpass that pink line at some point.
And that's why we want to have a tactical element to our strategies. It's not to say we want to be trying to move all in and all out, but we do want to adjust the way we emphasize where we're invested within the different asset categories that we participate in. So, and that will affect how we make those, when we make those revisions.
Good points, Chris.
Thanks.
Is this a new great financial crisis? Why should I be invested? So this is obviously a very, very negative question if any of us remember the great financial crisis. So right now, I would say absolutely not. Capital ratios at banks are about 3 times better than they were during the financial crisis. So that is all to say that banks can take on heavy losses to the tune of 3 times more than they could back then. I think in a lot of ways it's more than that based on the types of businesses that they're in. Now, I do expect that there's going to be a housing correction similar to the financial crisis, but the mortgage market is much healthier than it was back then. We see high loan to values, we see higher credit scores. There's lots of equity built up in the homes based on the dramatic increases that we've seen over the last couple of years. And there's, most importantly, there's minimal subprime and adjustable rate mortgages compared to, that was the market back then. And those were the first to fall. So if you think about, adjustable rate mortgages, if you're a subprime borrower and you have an adjustable rate mortgage, well, you don't make a lot of money, but your mortgage is going to go up, in some cases multiples based on that adjustable rate. And you might not be able to refinance into a fixed rate loan if you lose your job or if you don't make enough money. So that's what happened during a financial crisis. They were forced to sell their homes. There was widespread foreclosures, which led to bank issues. That issue is just less of a problem. It's not that subprime mortgages don't exist anymore. It's that they're a much, much, much smaller part of the overall market. And finally, why should you be invested? I thought this chart was interesting. I think you should have been invested throughout the financial crisis, as rough as it was. There probably was some reasonable adjustments to make back then. But the fact is that the S&P 500 is up almost 300% since then, since the Lehman Brothers collapse, which was, D-Day for the financial crisis. So I do want to talk about an overview of all the global concerns, because I think this is probably top of mind for a lot of people. First of all, on the financial side, I think the UK is doing the right thing by supporting the bond market due to the run on the pension funds that they're having right now. So that's a little scary. That's kind of a risk of a financial issue, maybe inkling to what we saw on the previous slide. But the reality is, I think the Bank of England's responding correctly to some poor political decisions, and luckily the politics of it seems to reverse course a little bit. The ECB is on a similar path of the Fed with aggressive rate hikes, but that's not true throughout the world. Australia, Norway, and Canada, they're closer to that Act 2 type of thing than the ECB in the UK. The ECB at least in the Federal Reserve. So if we think about the Act 2 type of situation, Canada, Norway, Australia, we talked about how we're more significantly into developed markets, more significantly into Canada or North America, for example. So there could be some tailwinds there for, we are underweight international positions, but for our international positions, there could be a developing tailwind there a little bit as those central banks start to get less tight on their monetary policy. War, it's great that Ukraine's winning the war, but it obviously increases global danger. It increases the rhetoric coming out of Moscow from Putin, and there's been a lot of threats of escalation. So, just another reason to be more defensive, I think. I think practically speaking, you need to think about what you can do for yourself if there is a prolonged issue. I'm not sure, from a financial positioning standpoint, there's much we can do about, nuclear war, for example.
Yeah, that's been a question that's come up more for me in some of the meetings I've been having where, there's been this rhetoric escalated about tactical nuclear weapons. And, in our commentary in preparation, I said, is there any way we can address this? And you kind of jokingly said, well, war is bad for your portfolio, initially, right?
War is bad. Yeah.
But kidding aside, I think it's somewhat, hard to even, fathom the idea that we would have a true, nuclear exchange of some form, even tactical nuclear weapons. That being said, if you are especially concerned about, that kind of a geopolitical outcome, the likelihood is that, at least for a time, that would be very disruptive to markets, the economy, and, whether or not, again, we're talking about a more limited, tactical kind of concern. The reality is that it would create havoc in the markets. And if that was something you particularly are worried about, it may become a question of what's your appropriate, level of risk to be entertaining as an investor as to how we want to structure your portfolio. Long term, markets respond to earnings. And so, I think our general premise is that given time, markets will rise because we expect companies to be more profitable. In past talks like these, Brian has shown different occasions, including in the World War II era, when markets rose because of increasing profitability from companies throughout, even in wartime, and various occasions this is indicated. So, I think the first thought as it relates to this is let's not overreact. Number one, in that the probabilities of this kind of escalation to that extent, we have to evaluate how probable is that. At this point, I think our expectation is that that's less likely. That doesn't mean it's outside the realm of possibilities, but hopefully for all our sakes, it's not a high probability event. And then when it comes to the allocation that you take, if you need to be more defensive for your peace of mind when it comes to a variety of issues, including this one, let's talk. And let's talk about what would be an appropriate way to sort of mitigate these risks to your financial life. So that's just a few thoughts.
Yeah, so I had a comment there on U.S. politics. It just the after midterm elections, the market typically does historically well. But I wanted to jump to this slide just because of what Chris said there at the end. If you feel uneasy about short-term risk, let's discuss your risk profile. And I've left that sentence up there on takeaways all year long because I really mean it. I thought it would be a difficult year and that people would feel uneasy. Admittedly, it's been worse than I thought at the beginning of the year, but this sentence still rings true. We should be invested for the long term. So if you're worried about short-term risk, you're likely taking too much risk. We have been conservative and will continue to be for now. I'm reaching the point where the portfolio is almost as conservative as I'm comfortable making it. And if I make it much more conservative, well, what I would really ideally like to do is have everybody discuss their risk profiles, because if I have an 85% stock position, for example, and I bring it to 75% stock, I'm not going to bring it to 65% stock because I'm doing a disservice to the person who signed up for the risk for 85% stock. So if you're taking a lot of risk, let's just discuss what we're trying to do. This is going back to Act 1 and Act 2. This is about a year ago. This is a situation that we were in, and it worked out great for us, right? We were in back then it was the pandemic. It was before vaccine and after vaccine. And before vaccine, there was one playbook, and after vaccine, there was another playbook. And we're in a similar position now. Today, it's not the vaccine. Today, it is Federal Reserve tightening in response to inflation. And Act 1 is we need to be defensive because we are unsure where inflation is going to go, if it's going to start dropping more rapidly due to these measurement issues, due to the tightening that we've had in 2022, or if it's going to be persistently high, as it has been, particularly since June. It did fall a little bit, but it has plateaued a little bit, which is to the displeasure of the Federal Reserve. So that's something that we're watching. That's going to be all Act 1. Now, Act 2 is going to be when that starts to reverse course. Now, we know that through measurement issues that this is going to get more negative in some areas in 2023. We could see that new and used car prices are slowing down, so that durable number is going to continue to get better. So if we start to see some lightening up in the job market, continue dropping jolts, we might be getting closer to what we consider Act 2, which is, beyond this inflation issue that we have today, in which case we might want to get more aggressive, particularly in the Nasdaq type names. So, Chris, I'm not sure if you have anything more to add to that, but I think, I think we're ready for questions.
I think the one thing I would like to have you offer some perspective around as we go into the questions. And by the way, we do have a few questions in the Q&A section. Please feel free to add any additional questions you'd like us to address there. One thing I'd like you to add some perspective around, Brian, is the Federal Reserve has been really aggressive at the rate increases that we've seen. With these 75 basis points at a clip. Is this common? Is this rare? How has it happened before? To what extent? What can we look at for perspective as it relates to how this has had a pretty dramatic consequence on bond investing? Where does this fit into the realm of perspective?
This is extremely rare. This is some of the most aggressive Fed policy that we've seen in 50 years, since Paul Volcker's 1980, 81, 82 type situation. Now, the fact that we have inflation 8% is less rare, actually, historically speaking. We talk pretty often about how we expect this situation to be similar to the post-World War II, 1946 to 1948, 49 type situation. Inflation actually reached 20% back then. And that's actually kind of lost on economic history. It did come down with time, but it was a dramatic spike similar to what we're seeing today. I think there's a bunch of issues that led that to get to 20% more than it's going to be today. But this is very dramatic. I mean, this type of rapid increases in bond yields is unlike anything that most of us have seen in our professional lives.
Thanks. I think that's important just to point out to people, and why it is somewhat an anomaly when it comes to the way the portfolio it works in combination with the different parts, and that asset allocation still has virtues. It just is challenged at this particular moment as a consequence of this issue. Let's go to our questions. The first question is, what about semiconductors with China threat on Taiwan? Do you want to talk a little about that concern, whether it's China as it relates to Taiwan and its impact on semiconductors?
Yeah, it's a real concern. So Taiwan Semiconductor is the biggest manufacturer of semiconductors in the world. It's not really even close. There's a few other producers like Samsung in South Korea. They're building some big fabs in Texas. Micron in Boise, Idaho is building a $100 billion plant in New York. I think this is a big part of why we passed that CHIPS Act this year, to influence companies to onshore chip manufacturing. The United States mostly does chip design and outsources manufacturing. Intel, Micron, NXP, they do some manufacturing, but Taiwan Semiconductor's the big one. So yeah, it's a real concern, and I think the government's trying to address it. From our perspective, I don't know who asked that question, Chris, but if they own the individual stock portfolio, they might notice that Applied Materials is their biggest position. Applied Materials makes the picks and shovels for semiconductor manufacturing. So if we're going to have a lot of onshoring, I expect that to have a long runway on earnings growth. If you're worried about the ban on sales of the high technology chips that the administration has put on, that's mostly going to affect companies like NVIDIA and AMD. Those are separate issues, and I think right now it's hard to determine how big of an effect that will have on their overall sales growth and trajectory.
Very good. David asks, with winter arriving and oil and gas prices rising, with projected shortages in New England, how will this impact investment options as we move into the next year or two?
Yeah, so I've been asked a lot about utilities recently, and I don't know, but maybe David, maybe you can elaborate if that's what you're getting at. Now, the problem with utilities is they're regulated entities, and that's a good thing and a bad thing, right? So the government basically says how much profit they can make based on the capital projects that they've done over the last 12 months, and it's typically between 8 and 10%, which is great. You know, you can almost get a fairly certain 8 to 10% return on your money over time. And if you look historically at XLU, for example, the utility, that's about the 10-year annualized return is around 10%. Now the problem with that is with rising rates, rapid rising rates, they're going to act like a long-term fixed rate bond, which they have. It's fallen significantly more than 10% over the last month or so as we got that shock from the Federal Reserve. So, I'm cautious going into things like utilities. They're not based on floating market rate prices, at least not all utilities are. Now, if you're thinking about the overall economy, energy is a huge input into everything we do. And we've seen manufacturing slow down in the United States, and that could be partly due to, the fact that we need less stuff than we did in the last 2 years. But it could also be part of the fact that, the inputs for manufacturing have become more expensive. We got a PPI number today of, I think it was 8.3% annualized rate. It was a little hotter than expected, down from the height of 11.4%, I think, in June. So again, that's high, but declining inflation for producer prices. It's still high. It's not a great thing. But again, over time, I expect that to more rapidly fall into 2023.
I think a related thing to touch on would be what's happening in Europe as well. There's, expectation of a pretty significant energy shortage this winter, and some of the challenges they'll have as an economy. And perhaps that's just one more reason why it makes sense for us to be underweight international at this time. But is that something you're worried about for spillover effect to U.S. earnings and U.S. markets?
Well, it could certainly spill over, especially because it's creating this issue with the strong dollar, and with some translation issues, it's going to hurt EPS for U.S. companies. But also, Europe is a big trading partner with the United States, with a lot of revenue being generated overseas. So if they're going to have elevated utility bills, then it's going to damper what they would buy elsewhere. I would emphasize, and one of the things that we've been managing our portfolio for is, we are more of a bytes and bits economy than we are an industrial production economy, especially when compared to Europe. So I mentioned before that I think with falling inflation, the Nasdaq type names will do better. Well, I think this is just another reason. Their input costs on things like energy are much less than something like a Honeywell, who is a German manufacturer that's going to rely on electricity and aluminum production more than somebody like Microsoft, for example.
Okay, and if you would just advance the slide while we're answering a few more questions. If you have questions, you're welcome to indicate that in the Q&A box. I would like to hear from you and try to address whatever we can. While we have the moment, I just want to remind everybody about our upcoming financial planning webinar coming up on November 16th. The next question is from Betty. She says, any thoughts on digital currency? And Betty, we have a lot of thoughts on digital currency, but Brian, why don't you maybe give some perspective as to how we think about this as it relates to our portfolio construction?
Yeah, I don't like to get into any kind of asset that I don't fully understand. And I think that's the biggest problem with these digital currencies. They don't seem to have much use right now. It doesn't mean that they will in the future. It doesn't seem like Bitcoin for example, has any use in practical life whatsoever. Doesn't pay an interest rate. You can't hold it. You can't build anything with it. You can't transact with it. So I struggle to see,
for the most part.
I struggle to see where the value is there. Some of these other, you can make an argument that Ethereum has a bigger network where it can, more easily transact. But it's not part of our daily life, and until there is, I'm going to remain skeptical. But I'm happy to change my mind in the future. I change my mind all the time. As John Maynard Keynes once said, when the facts change, I change my mind. What do you do, sir? And that's the position that I'm going to continue to have on cryptocurrencies.
I think by and large, Betty, our view has been consistently that we think it's a very speculative position to hold, whether it's Bitcoin or Ethereum or one of the others. It really remains to be seen, which will be the lasting or whether it is yet to be created, cryptocurrency. As a speculative investment, it's generally not a great fit for the clientele we serve. And we're less inclined to have things that can have the degree of volatility and swing that digital currencies typically have. We think that the blockchain technologies is going to continue to be increasingly utilized and have more applications over time. I think it's very possible that, as Brian said, we'll be watching this and revisiting this as an issue. But I often make the analogy that, when we first started learning about the internet, the stocks that were high flyers at that time didn't necessarily become the ones that you'd want to own to, America Online as an example or something like that. It wouldn't be necessarily the way you'd want to stay invested long-term over many years.
One of the things that I've noticed, Chris, just to add, we've been in a period here where it seems like there's a lot of investing fads. You want to be careful not to fall into them, right? There were stocks that were quote unquote going to the moon, and a lot of them didn't make any sense to go to the moon. There were SPACs, there was the metaverse craze, there was a cryptocurrency craze. I started off a few slides ago showing that, Bitcoin futures ETF is down 60%. One of the arguments for cryptocurrency is they're not making any more. Well, now there's like an untold amount of cryptocurrencies.
Different choices.
There was Dogecoin there that was hot for a while, and GameStop, and these Reddit board market corners that were going on, and in almost all these cases, it seems like people have lost money. So I'll in dramatic amounts of money, and I'll continue to be more cautious.
As a follow-up, Betty asked, do you see any opportunities in the battery farms industry? I assume this relates to, is this related to solar? All the solar work.
Well, it could be related to a lot of things. Elon Musk is CEO of Twitter, and he's certainly a lightning rod. But one of the things that he mentions a lot is that he can't get enough of lithium for the batteries in the cars. And as the whole world seems to be moving from the internal combustion engine to electric cars, we're going to need more lithium. Now, if you look at any kind of lithium ETF, very, very volatile. I don't think it's an easy thing to mine, which is partially why I think there's not enough of it. So, again, these are things that could be the wave of the future, but I don't feel any rush to jump into things that are unproven, especially when the market's giving us blue chip names at great prices today. There's no reason to be speculative.
All right, Brian, I don't know if there's any kind of wrap up, but that looks like it's it for the questions this time. Did you have any parting comments you want to add?
I just want to continue to emphasize that, we have been conservative all year. I know it's been painful. And I think the conservative positioning that we've had has been beneficial, believe it or not. Going back to that slide is, what has the average investor done? And I do think that there will be light at the end of the tunnel at some point. The market's suggesting that it's gonna, inflation at least is gonna lighten up in 2023. And I think my biggest concern is we're actually so defensive that I don't want to miss out on the recovery. So one of the things that I'm actively thinking about is when the recovery happens, how can I be positioned appropriately so that you all take advantage of the recovery? I wrote a letter that will be going out to everybody, and I said that I wanted to limit pain, but also position for the recovery, which is a very difficult proposition to do. But that's the biggest thing on my mind today.
I think it's a great point, Brian. Try to encourage our listeners here to our viewers to be thinking in terms of years, not months, not days. As we look out a few years, it may be a very different story than what we're going through today. So try to hang in there. We're doing our part to make adjustments and try to position you well. That being said, if you have any challenges, any questions, any uncertainty that you'd like to review with us, let's talk. We're available. We like to put this all into the context of the financial plan. Oftentimes when we give that context, we see that, those financial plans have probabilities of success, and those encounter and, anticipate market volatility and disruptions as part of that process. So don't necessarily get overly anxious in the midst of it. It's definitely uncomfortable. It's definitely challenging. It's worth reviewing if you have concerns, but by and large, we think most people are better served to largely stay the course rather than make adjustments. Brian, thought this was a great presentation. Thanks for your efforts today. For everyone else, please stay tuned for our disclosure pages as we go through at the end. But thanks for your time today. Okay, thanks everybody.